This is Addy. I'm trying to make a video on a couple of my favorite strategies in the options. Basically, why should you even listen to me? I've been trading options for the last 9 years, and don't get me wrong. My first 4 or 5 years, I was making a loss as well every single year. I wasn't profitable until I learned how to actually sell these options correctly. Now, I'm not calling myself an expert here, but I can be a guide who you can who you can follow and learn from, and see if it works for you. I mean, there is no sales pitch here, but see if this method works. So if you're struggling to make any profits in the market, if you're buying stock, you're buying options, you're buying all kinds of crap in the market, and then it doesn't go up on you, you're possibly buying it on the top. Maybe you need to change the strategy and then look into selling these options. That's what I've done for the last 8 or 9 years. It's a hard skill to learn, but once you learn it, I can guarantee you that you will never go back on buying options because there's a very low probability of winning in when you buy the option, and I can show you that on the platform here. But today we are going to cover two of my favorite strategies. First one is the credit spreads. As contrarian traders, we sell into the strength of the market. Basically, what that means is when the market goes down, we sell puts and we go long. It's also called risk reversal. It goes up, sell calls in that ticker or the underlying asset. And I will take you through the here. Um, so far, year to date, I've been profitable. I've made about 20-25% in my on my account after commissions. Well, I'll say after commissions, 20%. But that's also because I've not taken that many positions. I've not really been that active. First part of the year, first 6 months, I wasn't really that active, but then I picked up a little bit. But the idea is like it's not what I'm doing that you have to exactly. You then have to improvise. You then have to bring in your own methods. But the idea is like you learn the basics of option selling, how to choose the strike prices, how to be profitable in this trade. Um, and trust me, just devote some time in this. And once you learn it, it might be helpful. And if it's not, then move on. Keep doing whatever you're doing right now, and see if that works on. So first up is credit spreads. Three main points here. It's risk defined and it's reward defined, meaning you know your risk going in, you know your reward going in. It's a high, and then obviously time decay works in your favor because we are selling these options. So let's dive into the platform right away, and then I'll show you. Let's take an example of Tesla, right? I don't really trade stocks that much because it's really high buying power, meaning I have to put down a lot of money to do this. Um, um, Futures options. So actually, let's take a look at the example where I have a position on in my live account. Now, this is my paper trading account. You can see here on the top left, it says simulated trading. But I do have this live position in my account. I only put this on a couple of days ago, so it's not really that profitable yet. But here's the example. So look at the chart of ZB. ZB is a 30-year bond futures. Um, when, this has been the price action in this ticker, um, going down completely for the last few days, and this is where we pick up on the upside, meaning we sell the puts, and then we go long this underlying asset. Now, how do we select our strike? Or there's one thing missing here in my view because recently so there are a couple of things missing. And if you're trying to learn, this is how I set up the option chain view. Bring in delta, open interest, because open interest in futures, open interest, and we don't even need net change. What else do we not need? Bid and ask we do need. Last, actually, we don't even need the last price. We can just work off the bid and ask. So theta, delta, and then open interest. I mean, another thing for you to learn from is to bring in the probability of in the money, meaning how probable it is for this strike to be in the money and for you to lose. Because when you're short selling, you don't want the stock to be in the money to you, right? So, and probability of in the money goes hand in hand with deltas. So if you have either one of them, it's totally fine. But if you want both of them, you can just bring that in. Okay, so how do we select the strikes? Now, the first thing first, we select the ticker. right? The underlying asset that we want to sell options in. After going through some my watch list on the left, I've selected bonds, 30-year bonds, because if you look at the price action in any other asset, I mean, he has gone through the roof on the upside, so I will not trade this. I will not sell calls here. I mean, I'm a little bit cautious selling calls in the indices when the so I would love to sell calls here, but I will not, because I know my strikes are going to be breached, and this thing can this thing can keep going up and up. So I don't want to sell calls here as of now, because volatility is on the downside. You look at the implied volatility chart; it's coming down. It's on here. It's basically on its butt right now, 17. So I don't like this trade right now. Any other? I mean, CL. I just made some profit in CL, by going long when it went. And I mean, I was just lucky that it went up after this war, the Israel thing, the war thing recently. But that's not what my rationale was. My rationale was just because the price was on its butt here, somewhere here, 67, 68 or 70-ish, and then I went long, and then it went up on me. Anyway, that's the trade that's already been done. This ZB trade, I have it live in my main trading account, so I'm just going to go through this one right now. Credit spreads. Now, we're selecting anywhere between 43 to 50 strike. 43 to 50 days to expiration. This time, 43, perfect sweet spot here. We go down, we select 17 delta strike to short the strike, and we go right click and sell the vertical. And then all you need to do is always make sure you don't take too much risk here. Always go into like one contract, learn this trade, and then increase your trade size. 15 and 14. That's what I do normally. Just go one strike out. So from 15 to 14, and then we're collecting 9 ticks. Now each tick is $15.625. Don't ask me why, but that's the funny way. That's how the products are built. Each tick is $15.625. So if you have a year in the middle, first of all, look at this probability of profit here, 86%. That's what we like. We like a number 8 or 75 or 76, 77, anything good. That's the number we like. So always make sure you have this thing going on. Then the total number of dollars that you will collect. So 140, the bottom left here, teeth size. So you keep looking at this thing here. When I hover over the chart, take a look at this thing. This is the max profit in this trade available, 140. And the max risk is 1859. So basically 1,000 minus 140, whatever. That's your max risk. But we never go to max risk. We trade if it starts breaching, right? So what that means is if the price goes down on us, so it starts from here and it keeps going down on us, and let's say it's at 117, right? And we are long this market. We will convert this into an iron condor, meaning we will sell the put side as well. Call side as well. Convert this into an iron condor, and then we sit on it. And then if the opportunity is still there, the volatility is still high, we will sell another spread because we will not put any more buying power into the trade. And I can take you through the whole thing. Right click, say, oh, I'm going in with like 10 ticks. This is the beauty of selecting your own price. This is what you call price discovery, limit orders, whatever you want to call it. Go above the market. So the market is trading at 9. I'm going in at 10 ticks. I'm going to right click and I will confirm this trade. Look at the buying power. I'm only putting down $246 and I'm collecting $151 after the first credit. Now the first credit is $450, and then when you get out of this trade, it'll be another $450. So that's $9, right? That you have to pay to get in and out. But you're collecting $150. Even if you close this trade, which is I close my trades at 50% of profit, maybe 60 sometimes, depending on how the volatility is going in the market. But even if you take $90 out of this trade altogether, you've put down 246. Now remember, this margin is not going to stay static. It will change with the market. So if the market goes against you, they will debit your account with more money, meaning they will take more money into this margin account. So they will charge you more for buying power. But it's not going to be more than $400, $500 max. So let's say even if you end up paying $350, overall in this trade, that's 25% return, right? And I'm talking about after commissions here. $90 you can easily collect after commissions. Um, the other thing is, this is just one trade that you've done. Now annualize this trade. You can do this trade 5 times, 6 times, 7 times, 8 times a year, because you're selecting 45 days out cycles, right? So every 30 days you can put this trade on if the opportunity is still there. If not, you just move on you take your credit, you go somewhere else. Now, every single futures options product is capital efficient. That's why we trade this. You show me another product and I will show you the exact same thing. Now, the exact equivalent of this 30-year product, for example, we were collecting $150 here, right? Now, if I want to collect $150 in the ETF of the same product, first of all, I have to select a weekly cycle in 43 days, which is fine. For learning purposes, we can just use that. 89 will be my strike, right, at 17 deltas. Actually, I won't even collect enough if I go 17. I have to go 23. So let's go here, vertical, select one contract, and then go 90 and 88. So we're collecting 34 cents here. Now, this is the exact same setup, and always make sure your date here on the bottom, break even, is same as the date on top here, 11/23. So look, how much money am I collecting here? $34 in one contract. So that means I have to select either a wider spread, meaning this spread needs to go wide, and I don't want to do a wider spread because that means I'm taking too much risk in one product, and I don't want to do that. And the only other option, or the only other way to collect more credit, is to go more units, and that's how you collect more units. But look at the buying power. If you confirm and send here, your buying power is almost 3 times, $664 versus 250, 2.5 times, right? Same amount of credit. So all I'm saying is, futures options are capital efficient. They perfectly gives you exposure of the market that you want the exposure on. You have enough products to trade to get exposure in all the markets that you need, and there are enough products available to diversify your portfolio. When I say that, I mean you can go into metals, which are gold and silver. You can go into grains, which are wheat, soybeans, corn. Then indices, SPX, Nasdaq, Russell, Dow Jones. We don't trade. It's a bigger product. We don't trade that. And then you go Euro, British pound, Aussie dollar, Canadian dollar, and then you basically have exposure to all the markets here. If you volatility, the VIX futures trade, gold I've already mentioned, and then what else? Currencies I've already mentioned, and then interest rates. Obviously, we're doing the ZB. There are ZNs available, ZFs meaning 5. Back to our original trade here, and the market's about to close. I want to put the order in, and then get it filled, just to show you like how we trade this. Have I put the order in? Let me check. No, I haven't. Okay, analyze the market is still trading at 9 ticks. I mean, I'm going to take this so that okay, I'm also collecting the same amount of credit that I was doing on the TLT stuff. But again, look at my buying power. Okay, it got filled. So now what happens? Now it's a put spread. You have the put spread on. Perfect. You have some long deltas, meaning here. Where the slice is gone here. Okay, it's closed. This is the one. So you've collected positive 37 deltas. You're short gamma a little bit for options. Theta is positive because when you sell options, you are positive theta. And then you're short vega, meaning volatility has ticked up and you are selling the vol here. Now look at the chart. Volatility has not ticked up that much, but it is around its average levels here, 14, 15 for the year, annualized. So these are the volatility levels that you want to keep an eye on and sell into, because look at the chart. Implied volatility always comes down to its normal level. It's mean reverting, meaning when volatility ticks up, it comes down to its mean level, and that's why you always sell it when it's high. Okay, so the trade is on. Now what do we do? Quickly, I want to show you. Let's say if this trade was getting tested, meaning and then the market goes down on us. Fine. And it's sitting at 25 delta. So we go on to the call side, sell the 25 deltas, and then we flatten out the deltas so that we don't have any more directional risk in the product. Um, we will convert this into an iron condor. Look, oh, nice credit here, 15 ticks on the guide. That's probably because there's a lot of skew available. Now, look, when you sell the other side, you don't really put any more money down because they have money for risk on one side, meaning the market, you will too far too quick on either side, right? That's why the risk, the way they charge you the money for this trade is they expect that the market will can only go one way, and that's your risk side of things. So therefore, when you sell one side, that's the max down. I shouldn't say max because look at the call side. When we sell the calls on top, um, we don't pay much more credit down. Only $30 more to put down, right? And then, but look at the overall credit. So you're collecting 229 here, and then you collected 136 on the other side. That's all $400. That's the beauty of iron condors, which I was going to talk about next, but I don't think we have time. We can cover it here. We start with a put spread. It got tested. We will sell a call spread, convert this into an iron condor, make it flat neutral, market neutral strategy. And this is how we do it. We just take the market here just to like build the trade. And this is my trading account. You can do the same thing. Just keep testing it, keep practicing out. Actually, if I go into my working orders, it's not getting filled. It's trading at 14 now. Not filling. Anyway, I just wanted to show you the chart, once it gets filled, like how does it look on the ad with the whole iron condor on. That's the idea. We can even take one tick list on the market. Oh, it filled. Okay, great. So now we have 4 legs, but $359 remaining in this trade. Overall, $640 credit, max risk. Now, again, if you are struggling in the market, you are not making enough profit by just buying and selling options, which is a very low trade, pretty of profit. Try something different. Try this thing. Try selling small amounts. You can start with $1,000. You saw this, right? You only need $240 on one trade. With a $1,000, $1,500, $2,000 account, you can start with like 2 different positions on. I will only recommend putting 50% of your max allocation at any given time. Meaning, if you start with $1,000, do not put more than 2 positions on, maybe even 1. That's what I would do. If you start with 2,000, start with 2,000, and then just learn the trade. Just learn the skills here. See how it all works. I have a new event coming up. It's not updated on the website, but keep an eye on this if you can. I will be updating this thing where we will detail slides with more nothing. So if you like the video, follow the page. Thank you.